How dividends create passive cash flow is one of the most misunderstood ideas in investing, because many people think passive income means fast money or doing nothing. But dividends work slowly, quietly, and consistently, which is exactly why they are powerful. And dividends are simply a portion of a company's profits paid to shareholders on a regular basis, meaning when you own dividend-paying stocks, the business works while you sleep and sends you cash without you selling anything. And this is important because most people rely only on active income, where time equals money. And the moment you stop working, income stops. But dividends break this cycle by separating income from effort, and the real power of dividends comes from reinvestment. Because when you use dividends to buy more shares, you increase future payments automatically, creating a compounding effect where income grows even if you never add new money. And this is why dividend investing rewards patience more than intelligence, because the biggest gains happen over long periods, not months. And many beginners avoid dividends because the payments seem small at first, but they forget that consistency beats size. And a small dividend today becomes a meaningful income stream after years of reinvestment. And another advantage of dividends is stability, because companies that pay dividends regularly are often established businesses with steady cash flow, which means less volatility compared to speculative growth stocks. And this makes dividend investing ideal for people who want lower stress and predictable income, especially during market downturns when prices fall but dividends continue. And dividends also create emotional discipline, because instead of panicking during market drops, dividend investors focus on cash flow, not price, understanding that temporary price movement does not affect long-term income. And over time, this mindset protects investors from emotional decisions that destroy wealth. And another reason dividends create powerful passive cash flow is that they scale, because as your portfolio grows, income grows with it. And eventually dividends can cover basic expenses, then larger bills, and eventually entire lifestyles, turning investing into a financial safety net rather than a gamble. And unlike rental properties or side businesses, dividends do not require daily management, repairs, customer service, or stress, making them one of the most hands-off forms of income once a portfolio is built. And dividends also provide flexibility, because you can choose to reinvest during growth years and later switch to taking cash when you need income, making them useful at every stage of life. And many people underestimate how reliable dividends can be. But history shows that quality dividend-paying companies continue to pay even during recessions, making dividends a source of stability when other income sources fail. And the key to success with dividends is not chasing the highest yield, because extremely high yields often signal risk, but focusing on companies with sustainable payouts, strong earnings, and long-term growth. And this approach builds income that grows slowly but safely. And the biggest mistake new investors make is quitting early, because dividend investing feels boring compared to fast trading. But boredom is often the sign of a strategy that actually works. And when you understand that dividends are not about excitement but about freedom, your mindset shifts from short-term profits to long-term cash flow.